Okay, picture this. It's October 2008. You're a 58-year-old manufacturing supervisor in Cleveland, Ohio. You've worked at the exact same plant for 31 years, and you've faithfully contributed to your 401k every single paycheck since, what, 1987? You did literally everything the financial advisors told you to do, right? You diversified, you stayed invested, you thought long-term, and then your statement arrives in the mail. You open it up, and you see that in just 11 months, your retirement portfolio has lost 43% of its value. Boom. About $312,000 has just completely evaporated into thin air. You were 7 years out from retirement. Now, maybe 12. It's an absolutely devastating emotional hit, and you're sitting there wondering, did I do something wrong? Well, the uncomfortable truth is, you didn't do anything wrong, but you kind of didn't understand what you were actually invested in.
But let's look at a crazy contrast here. Right across town, there was another guy. Same exact age, same income, same career. But his portfolio, it was only down 11%. He didn't panic, he didn't call his broker dripping in a cold sweat, and he sure didn't push back his retirement date. The difference here wasn't luck, and it definitely wasn't some kind of insider knowledge. The difference was that this second worker deeply understood the massive stakes of what we call the danger zone, that absolutely critical 10-year window right before your planned retirement. He had built a portfolio designed specifically to, well, resist destruction. So welcome to this explainer. Today, we are diving deep into that pre-retirement danger zone. And, more importantly, we're building a concrete defensive portfolio checklist to help you minimize those life-altering losses. All right, let's jump straight into our checklist. Number 1, preventing panic selling. 2, picking defensive assets. 3, hedging with gold. And 4, rebalancing annually. Let's get into it. Step 1, prevent panic selling, the psychology of survival. Take a look at this data. This is from the famous Delbar study, which basically tracks investor behavior over these long 30-year stretches. Now, you might think people survive recessions by perfectly timing the market, right? Yeah, they really don't. Notice how the average retail investor actually underperforms the S&P 500 by about 4.3% every single year. Why is that? Well, it's because we're human. We are literally wired to panic sell at the absolute bottom when fear is at its peak, and then chase returns at the very top when everyone's hyped up. And by doing that, they take what are just temporary paper losses and crystallize them into permanent financial devastation. Which brings us to a really massive question for us today. How do we actually build practical resilience instead of just, theoretical resilience? Because, hey, in theory, anyone can white-knuckle it through a 50% market drop. But in practice, watching half your life savings just vanish forces capitulation. The real secret here is that you need an emotional anchor. By holding defensive assets that pump out consistent income, think dividends or interest, you create that anchor. When your portfolio keeps handing you cash every single quarter, even while the broader market is seemingly burning down, it gives you a sense of continued function. It proves your money is still working for you, and that physically prevents the kind of panic selling that permanently destroys your wealth. Moving right along to step 2, pick defensive assets, anchoring with necessity. Okay, the absolute crux of this step is understanding a little concept called inelastic demand. Seriously, this is the structural secret to surviving a recession. Inelastic demand just means products and services that consumers literally must purchase, no matter what the economy is doing. We are talking about non-negotiable necessities here. Toothpaste, electricity, insulin. Look, when a recession hits, sure, people are going to stop buying shiny new luxury cars and upgrading their premium electronics. But a bad economy doesn't just hit pause on biological reality. People still need to brush their teeth, wash their clothes, and manage their health, right? Check out these stark differences in volatility during the absolute darkest days of the 2008 financial crisis. While the broader S&P 500 crashed a jaw-dropping 56.8% from peak to trough, look at how the defensive sectors held up. Utilities, they only dropped 39.9%. Healthcare fell 38.5%, and consumer staples declined just 28.5%. That's literally half the decline of the broader market. Now, obviously, these assets don't magically prevent losses entirely, but they dramatically cushion the blow. Why? Because their revenues are firmly anchored by human necessity, not the fleeting whims of consumer confidence. Let's make this super real and look at the actual companies. Back in 2008, Procter & Gamble's revenue dropped a mere 5.4%. Contrast that with General Motors, whose revenue plunged 29.7% and ended up needing a government bailout. Look at Duke Energy. They're a regulated monopoly providing electricity. Their revenue remains completely flat through the worst economic contraction we'd seen since the Great Depression. Unbelievable, right? Or how about Johnson & Johnson? Making Band-Aids and surgical equipment allowed them to maintain their incredible 61-year streak of dividend increases right through the teeth of the crisis. Oh, and we absolutely can't forget short-term U.S. Treasuries. They actually gained value during the recession as panicked investors fled to the ultimate safe haven of the global financial system. All right, step 3, hedge with gold and contrast methods. Let's look at alternative defensive strategies. So gold is super fascinating because it doesn't generate earnings or pay dividend. As financial expert Prudence Su so perfectly puts it, physical gold acts as the drama friend of your portfolio. It's an absolutely incredible inflation hedge and a true safe haven when geopolitical or economic crises rear their ugly heads. You definitely want a small slice of it around when the markets get really ugly. But because it doesn't actually compound cash flow, it really shouldn't be the core engine that you build your entire financial life around. Now, notice how our tailored strategy contrasts with a pretty famous historical model.
Back in 1999, investment analyst Harry Brown popularized what he called the permanent portfolio. His model mandated this very rigid, permanent, equal 25% split between stocks, long-term bonds, cash, and gold. And while Brown's model is super famous for preserving capital, it is highly inflexible. It can really struggle during periods of rising interest rates, and frankly, it relies way too heavily on gold and cash. Contrast that with our tailored defensive checklist for near retirees. We're using an adjustable, purposeful mix of consumer staples, utilities, healthcare, short-term bonds, and just a targeted gold hedge. It gives you that practical resilience, but it still prioritizes assets that actually generate income.
And that brings us to step 4, rebalance annually, the maintenance engine. Listen, if you are within that 10-year danger zone, you absolutely must avoid what financial planners call sequence of returns risk. This is the highly specific, terrifying danger of experiencing a major market crash right at the exact beginning of your retirement. Think about it. If your portfolio drops 40% and you are forced to sell off those depressed assets just to pay for your groceries and your property taxes, you lock in those losses permanently. Your portfolio's foundation shrinks so much that even when the market inevitably recovers, you just don't have enough capital left to participate in the growth. It's game over. So let's look at how annual rebalancing builds an absolute fortress around your wealth. To prevent accidental overexposure to risky assets, you've got to follow these mechanical steps every single year. First up, assess your allocations. During a multi-year bull market, those exciting growth stocks of yours will naturally swell and end up taking up way too much of your portfolio. Step 2, sell off that overexposure. Step 3, intentionally lock in those market gains. And step 4, shift that capital right back into your defensive anchors, things like short-term treasury ETFs, high-yield cash, or those dividend-paying consumer staples we talked about. Regular rebalancing mechanically forces you to sell high and buy safe, which prevents you from having a catastrophic overweighting in risky assets right before a downturn hits.
When you put all this together, preventing panic with steady income, anchoring yourself in basic necessities, hedging smartly with gold, and rebalancing mechanically, you start to realize something really profound. For individuals stepping into that 10-year window right before their planned retirement date, survival isn't just the floor of the strategy. Survival is the strategy. Your goal at this stage isn't to beat the technology index. Your goal is to actually complete the journey and aggressively protect the 30 years of hard work you've already put in. At the end of the day, recessions are just an inevitable, cyclical feature of capitalism. We know for a fact they will happen. So I want to leave you with this final kind of provocative thought to chew on. The next recession is an absolute certainty. It just has an uncertain date. Are you actively structured right now to survive it without having to sacrifice your retirement? Thank you so much for joining me for this explainer, and I highly, highly encourage you to go take a close look at your own portfolio today. Catch you next time.